All right, we are live. We got a different face here today. JT might hop on a little later. He's with the kids, so he might just hop on randomly. But we got Mr. Isaac the Schick Newton, as you guys all know, and we got my buddy and partner Mr. Chris Stanford, joining us today as well. And we're just gonna go over some macro things today, see what we're looking at in the markets. So yeah, we'll go ahead and get started. How you guys doing today?
I'm doing pretty good. I'm trying to catch up on the markets right now as we're like on this call because I haven't really had a chance to look too much this morning. I've been running around pretty busy, but yeah, there's a lot going on in the world. So
sweet. Isaac, how you doing, man? How's the weekend?
Weekend was pretty good. Yeah, just hung out with the fiance, and yeah, everything's going pretty well. Work's been kind of intense, but just a lot going on.
Shit, I got
my internet cut out.
No, it's all good.
Yeah,
okay.
I'm in a really shitty place, man. I'm in the ghetto right now, so it's tough.
Guys, the joke is that
terrible, like subpar internet.
He's in my office, and I'm in my guest room right here. So that's why the background looks familiar. Isaac, did you notice it looked familiar?
I just thought he also didn't own a bookshelf. I thought it was just a similar, likes to stack them up.
Nope. He's in my office, and I just don't want to be right next to him and have the mics all echoing. So I'm here in this dark, cold spare room. So per usual, I'll go ahead and share my screen and go ahead and run through what I'm looking at on the charts. As usual, we always start with the central bank balance sheet. This is coming down. Last week when we did the call, we saw it first meet the 200-day moving average. We want to see this line kind of get below. We want to see this line get below the 200-day and kind of come up and test it as resistance and kind of start making its way back down. But only time will tell. We have the M2 money supply. It looks like it's kind of just consolidating. That definitely needs to come down as well. We want to get below our 62 EMA, and we have a while before we get anywhere near our 200-day moving average. I don't know if we'll ever get below that again, but we'll see. Gold still consolidating. We have the S&P still within this channel here. I'm actually zoom in to the weekly chart. We saw it kind of break out, and it looked like it was going to test it as resistance, but the markets are still kind of bullish. So we're back within this channel. So yeah, I wouldn't be surprised if we kind of keep going up. Same thing here on the NASDAQ, same thing here on the Dow. And if we look at Apple, it is hovering around this previous all-time high level. It looks like it's turning into support. Guys, got to remember, Apple is in the midst of the largest stock buyback in history. They have over almost $200 billion in cash to buy back their own stock. So I wouldn't be surprised if Apple's the last one to fall, but eventually it will, because you can't just keep trading at this crazy PE multiple. So now if we kind of go into crypto, we see Bitcoin. It looks like it is. Let me go to the day chart. It looks like it's trying to turn that $35,000 level into support. And in order for us to continue momentum, I want to see us get above this trend line. I want us to turn this into support. And I want to see a nice big green candle print right here. Kind of like we saw here, kind of like we saw here, kind of like we saw here. You can never time tops and bottoms, but you can confirm when bullish or bearish momentum is coming in. And a lot of people are thinking that, even the people that I follow online who are super bearish on the ETF getting passed, it seems like everyone's starting to think that it's going to be approved here pretty soon. But obviously only time will tell. Either way, I'm still bullish Bitcoin in the long term. We see ETH pumping. We're hovering above the 200-day moving average. Let me zoom out back on the weekly here. And for ETH, I want to see us get out of this channel, and I want to see us turn this $2,000 level back into support in order to confirm bullish momentum. We are above our 62 EMA. We are above our 200-day, but we're still within this channel that we've been in since pretty much May, June of 2022. So a lot of traders are looking at this when they're going to make their decisions. So I do believe it has a big effect. And then if we just look at the total crypto market cap, it looks like we got above the $1.25 trillion level that has served us, a pretty respected channel. If you look at how price has been respected in these channels, it looks like price is trying to get above and test this level as support. We're above our 200-day and our 62. So it does look like the beginnings of a bull market, but we still have to keep in mind that, we are expecting a recession, between the end of this year, Q1, Q2 of next year. So yeah, that's what I'm seeing on the charts. What's your guys' thoughts on this?
I think for me, my thesis is pretty simple. I don't feel like I have anything to add in terms of valuation of currencies. Not that I don't believe in them, but it's just hard for me without any intrinsic way to value them. So like purely based on technical analysis, obviously the technicals, are pretty strong from a standpoint of the fact that it's proven to hold in the lower range for a long period of time over like, a 1.5 year period or so that range has been sort of held with Bitcoin. So, it seems to me like if somebody's willing to take that risk, that they could definitely be rewarded for doing so. But for me, just not my game that I play. So I don't think I have anything intelligently to add to that.
So what do you see in the overall economy? Where do you see us going, like maybe here in the short term at the end of the year? I know you mentioned that you see a recession coming possibly at the end of the year. Yeah. We were more of the camp of like Q1, Q2. Yeah, I'd love to know like what plays into your thought on that.
It is November now, right? So we're talking like an additional month or so. So like, yeah, that timeline's for me. I just keep forgetting that it's not summer anymore. So yeah, I would say like in a 3 to 4 month period is kind of where I see things unfolding. I think what's interesting is that the market hasn't reacted to where I don't think they've reacted enough to where rates are, because there's this expectation that rates are going to go down soon. I think it's kind of it's priced into real estate and all these other asset classes. All this complacency is based on the fact that I think a lot of market participants believe that the Fed, can't stay where they are in terms of rates for that long and still be able to finance not only their deficit, but just in general, the way that the economy runs. A lot of it, a lot of these companies have raised debt at these really low levels, and the market has really gotten used to that. It's become this drug that's hard to wean ourselves off of, right? And so to me, I think that the Fed doesn't necessarily have the ability to stay here for very long, but it seems like they have the willingness to see how far things will go before it breaks. I think their goal, in order to bring inflation down, I think that you have to look at what has caused inflation. And yes, a lot of the inflation was caused by supply chain related stuff in, raw commodities and in, manufacturing and shipping and all that kind of stuff. A lot of the inflation that we were seeing was from the shipping and logistics. A lot of those things coming from Asia, right? Or at least a source product in their grand scheme of what they're manufacturing. One of those source products is likely coming from Asia region, which had the most strict COVID lockdowns, the most difficult, for a while was just the most difficult place to do business, right? And so that's what caused this global scale inflation in some of the raw goods and services. But when you look at what I think has really caused inflation, it's this wealth effect from owning assets like real estate and equities. People that own real estate and equities, they've gotten really rich from doing that, and they continue to get richer from owning. And so the growth in net worth is less from growth in salary. It's less growth in salary, and it's more growth in their assets, right? And essentially the asset values have increased so much that that's really the bigger source of their net worth. And the people that don't own these assets, which are, the poorest in society, they don't own real estate, they don't own stocks, they don't have mutual funds. Some of them do a little bit, but likely they have a very small portion of their net worth in investments. And so they're on the opposite end, where as these values keep going up, it costs more to rent, it costs more to do everything. So yeah, I think without them tackling that directly and actually deflating these markets that have been inflated, without doing that, it's hard to tackle inflation, because when you look at a person's individual spending and you talk about things like food, people complain about food and gas prices and these smaller expenses relative to like something like rent, for example. Rent or your mortgage tends to be a person's biggest expense that they have. So the price of how much it costs for you to rent or own plays a much bigger impact in the person's total net worth and their ability to actually be solvent individually than things like food and gas and, you know, clothing. So that's my opinion, that they are trying to directly deflate these markets in order to actually solve the inflation problem. And they're hoping by just saying that they're willing to do it and go as far as they need to go until things break. Like, they're hoping that the market will do their bidding for them and that they don't actually need to do as much in order to cause that to happen, so that, you know, they don't have to actually break things. They can just kind of like allow the markets to correct. That's kind of my macro view right now, and I've got a lot of plays based on that. But yeah, I don't know what you guys' thoughts are on that, but that's just where I'm at with everything.
Yeah, I mean, I believe we've talked a bit about this when we went over that study, or when I went over the study that was on what are the actual causes of inflation and what would it take to actually see like structural inflation, which I think is a lot of the things that Chris is talking about, you know, begin to become alleviated. And it mostly went over the fact that in the US, the majority of our inflation is housing related, usually tied up in rent and cost of housing. And we then looked into the reasons why housing is so expensive and why it's unlikely that cost of housing is going to go down. And it mainly boiled down to the fact that most people were locked into, you know, mortgages that were at rates far lower than the going rate now, and people are not selling houses. So even though the value for first time sale, like a sale on like a new home, is decreasing, the value on resale homes was not. And the issue was, if supply on housing was not increased, then you wouldn't see a significant drop in the total housing price. And if there's not a significant drop in the total housing price, you don't get a significant decline in these like more structural inflation, like inflation that's not food or G related.
I think used prices also, or not used cars, but just cars in general, used and new, also has that similar effect, because that's probably like the second biggest general cost that an individual has, right, in their life, is their, you know, their lease or their car payment. Yeah, I would agree with that. And I think, but what I would add though is, whenever there's enough blood in the water, it seems like a lot of that previous financing and previous situations tends to change a lot, because, you know, a lot of these net worths that you look at, the people that own these, you know, that are able to really own these homes and weather the storm, a lot of them are rich in equity in their businesses, right? You look at how a lot of even just the mega mansions, how a lot of those are financed. Yeah, they're cash buyers, but most of the time they're just getting bespoke lending on equities that they own. And so whenever, you know, like look at what happened recently with Elon Musk and how much Twitter, I'm still calling it Twitter, I refuse to call it anything else.
Same.
Twitter, you know?
Same.
But the effect that's having right now on all of his other things in his other areas, his other companies, just shows how much, like, you know, whenever you have equity positions and so much of your net worth is in equity, and all of a sudden your stock price drops 40%, you know, things change very, very quickly. And that trickles down to everybody else, right? Like the engineer that was super secure working for this mega company, and all of a sudden, you know, they're a little bit less secure. And so I think that has really, and that's why the Fed is being so like hard ass, because they know that they kind of have to create some blood in the water for things to really make movements, you know?
Yeah, no, I would agree. I think that it makes sense that they have repeatedly said that we're going to need to see unemployment go up before we can actually say that we're, you know, that we're dealing with the issues of inflation. For exactly, I think you did a great job of actually outlining why that is. In order to force these people to have to liquidate some of their assets, which will in turn bring down the value of the overall assets, they're going to need to see these people face some sort of financial uncertainty that would cause them to need more, you know, liquid capital. So yeah, I think that's a well, you know, stated, well summarized, I guess, like analysis of how our economy is kind of related to inflation and what that's going to look like going forward.
Yeah, thank you. I'm curious, what do you think about, this is just a play based on that thesis that the Fed, you know, they want to cause disruption in the market, but they can only do so much actual movement from here. So a lot of, the big name investors that I'm either paying attention to, like from an indirect way or directly in communication with, a lot of those people are buying bonds at this point. They're buying TLT, they're buying, the long dated bonds in thoughts that, they've moved so far in anticipation that the Fed is just going to keep going. But the reality is that they can only go so far, right? So purchasing bonds at these prices, buying like options on TLT, for example, I think is a really good risk versus reward, from a really good play from a risk versus reward standpoint. It seems like.
You want to explain TLT a little bit, just for people who may not know?
Yeah, so TLT is basically, it is like a 20-year treasury bond, but it's an ETF. Instead of having direct exposure to those bonds, you own an ETF that, mocks exposure, essentially owning a 20-year treasury bond. And so there's a huge thing in economics with the long dated bonds and short dated bonds, like government bonds, right? The government, they continuously finance all the stuff that they do, all their operations through selling bonds, selling debt, right? And what people look at in economics is the relationship usually between like a 2 and 10-year bond, and even like, a 6-month note, and something longer dated, like a 10-year or 5-year. And the relationship between those tells you basically how much is baked into, like, how much people think that the Fed is going to continue to move, and kind of where we are on an existing standpoint. And so I don't want to overcomplicate it, because this is like I think a pretty high level concept for a lot of new investors that maybe doesn't necessarily have as much relevance to them. But what should be happening in economics naturally is that you get compensated more for having money tied up longer periods of time. So if your money is tied up for 10 years versus 2 years, you should get compensated more for a 10-year period, because of the fact that there's so much embedded risk having your money tied up for that long versus just 2 years, right? Like, maybe more predictable in the short term. And so whenever you see that the shorter bonds are paying you more than the longer duration bonds, that tends to signal that investors think that the Fed is going to continue to move rates higher, and that potentially recession on the horizon. They've always said that it's called an inverted yield curve whenever the shorter duration is paying you more than the longer duration. And when it stays inverted for long enough, that is supposedly supposed to be able to predict recessions. It's done a pretty good job of at least predicting volatility, in my opinion. So that's one of the things that I'm trading actively and using as a hedge against other positions that I have that are in the opposite direction.
So I was actually seeing on Twitter, it was floating around that the yield curve has uninverted. Do you know if this is confirmed? Like has that occurred? Is there enough on that? Because I saw this literally today. I haven't had time to look into it, but somebody was stating that.
I think maybe it touched at one point to not inverting, but I don't think it's quite. It's very close though, which has become very interesting because it was inverted for quite a long time. Other thing people look at too is like the relationship between U.S. bonds and international, like what the curve is between those. Yeah, so basically this line here is having the zero yield curve. But if you look at basically the moment that this started inverting was around the time that the market started, like kind of reached its highs in 2022. This is right whenever the Fed basically decided that they were going to start raising rates, signaling that they were going to do it. And so it's been inverted since then. But yeah, it's very close to uninverting. And there's actually a trade. So the trade that I've been making is one, just long TLT with options. And then the second trade is you can actually buy the spread between 2 and 10 years. It's called the knob spread. And it's a trade that is kind of difficult to make with your average like TD Ameritrade type broker. I think most of the time it seems like the best way to go about trading this is through like a Tastyworks. Tastyworks is a good broker that offers that. And then I think Interactive Brokers tends to have the opportunity to trade that in the derivatives market. But otherwise, it seems like the only way to get exposure in this is through like an investment bank and having a
being a client of theirs under their Prime services. So it's not a trade probably that most people can make. But
And if we were going to use the inverted yield curve to predict a recession, would it be the case that most recessions occur after the curve has been uninverted, or do they occur during the inversion period?
That would be an interesting thing to go back and study. I've never really looked at that data point, but I would say that one, it's not a perfect indicator. There have been times that it's inverted and the markets didn't crash. Duration of how long it stays inverted is really important too. It seems like the longer duration that you have inversion, the more likely it is that you're going to have a recession.
So it is kind of interesting. This isn't something that I've thought about before, but I am looking at the same chart you were, and it looks like more or less every time from the recession we had in the early 90s, like starting in like 90, June or July 1990, the early 2000s, as well as 2008. Something I try to avoid, and I think Chris agrees with this just based off of the way he talks about, his like investment advice. I don't like to say things are absolutely going to be this way because they appear this way if I'm looking at a graph. There's a lot of studies that the Federal Reserve usually does, but other groups do it too. But there's a lot of good studies that can figure out like whether this is an actual, like, are we seeing something that is an actual studyable, discernible pattern, or is there something else at play here underlying it? So I'm not going to say you should use this 100% for investment, but it is kind of curious to me that it appears that on all four of these recessions, you get a period, whether very short or extended, that you have an inverted yield curve. And then after the yield curve, it looks like every time becomes uninverted, shortly after that, you get the recession. So it would seem that the recession, according to this, would occur after we see our own yield curve become uninverted again. And then now whether that occurs right after, like it looked like it did in 1990, or whether there is a period of a few months, I can't make any statements on that. But that's just something I find it kind of interesting because I was kind of curious, and it looks like that is generally how it happens. But I would also recommend I would almost guarantee there's a study on this that we could probably find. So that's my thoughts.
Yeah, I think what it is also is that the market tends to move, like the smart money, which tends to be in the bond market, right? Because bond market is much more of this like fixed financing where you can lever up, 5x and have much more predictability around what your returns are. And so that tends to have much more of an institutional base. And so what that ends up, I think, translating into in these indicators is that, the Fed, like if you look at the spread, it started moving like months ago, they started moving in June, right? So like midsummer. And this was before the Fed had officially signaled that they were, taking a pause. They'd kind of said like, we might do it this meeting, we might not. Now it's like, hey, we're going to hang out here for a little bit and see what's up, which, I knew that for a while. I think a lot of investors knew that for a while because you start looking at like the realism behind government deficit and how much, and just in general, what it would do to the banks and all these startups. And there's just so much financing that's fixated around a certain band of rates. And when it starts getting outside of that, there's this tremendous catastrophe. And so I think a lot of that is that basically the market is going to start to anticipate that the Fed is at the top of their cycle. And so even though they might not be lowering rates immediately, it's like them being at the top of their cycle, that means that they probably feel like this is as far as they can go before something breaks. And so if the Fed feels like that and they have all the data to support that, investors are also probably likely to think, okay, like why wouldn't they move more if they felt like they could move more,
That's good. Also, I see that JT has now entered the chat.
What's up, JT, what's going on with you, man?
Everything, man. How you doing, Chris?
Pretty good. Getting ready to head out of town a little bit, but
where you at?
I got to go back home to Pittsburgh. I just bought like a new car that I have to go like have to get my other car shipped back, and then I got to drive this one back here. So
Yeah.
Oh man, that's a journey right there.
yeah.
But yeah, I came in on the back half of what you were saying. I don't know if one of you guys were already going to respond to what he said there. I think the Fed. I heard him say, people think the Fed is done hiking. I wouldn't say they're done, but it's definitely an extended pause right now. And the reason I'm saying that is because so in the past 12 months, what they rolled off about $1 trillion worth of bonds off their balance sheet, which is part of the reason yields have been moving higher. And so part of the hold is the anticipation that we're going to continue to offload these bonds because we still have $4.5 trillion left, which would do some tightening for us. So in a sense, we are getting more restrictive, just not through rate hike policies specifically. So they are still tightening us a bit. Do you think, Chris, I'm actually curious, do you think that yields will continue to move higher from here? Or do you think, because today, for example, we saw a big decline in yields. So do you think they're going to be back to the upside? Yield specifically?
I think they have to. I don't think that they can support their existing operations as a government where we are with our existing rates, And then also, I just think that what they're trying to really do, and they continuously will signal all these different things, but partially, you have to read between the lines. Sometimes they want to get you to think one thing, even though they're going to do another thing. Because if the whole market starts thinking like, oh yeah, they're going to continue to raise rates and they are set on this path and they're going to play chicken with the markets until things go down, the markets are going to sell, right? And they're hoping that the markets will do their bidding for them. So that's less that they have to actually do on their end. And it keeps their dry powder, right? And so I think that that's why they've stayed here, because they know that they just can't go that much further. I'm sure they'd like to, but it hasn't quite given them the effect that they want just yet. And that's partially because there's a lot more to this equation than just simply raise rates till infinity. It's really complicated right now. But I think they're just hoping that the markets, by them signaling that they're willing to play chicken, they're hoping that the markets will do all the bidding for them.
Yeah, that's true. Yeah, if we were to see a 6 handle on the Fed funds rate, stocks would be murdered. They would be murdered that day. Yeah, I guess on the flip side, we have housing still at the most unaffordable level pretty much in history. We saw some pullback in mortgage rates on the 30-year fix, but I think that is very temporary because remember, the Federal Reserve still has, I can't remember the exact number right now, my apologies, but they still hold a good chunk of MBS, mortgage-backed securities, on their balance sheet as well. And the way monetary policy works when you're offloading mortgage-backed securities, it actually puts more upward pressure on mortgage rates. And so they still have that in the backdrop as well. And so I guess, to me, it's almost like they're stuck. And that's part of the reason, Jay Powell he's carrying out that tone that he's carrying out because, he doesn't know. No one knows, including the chairman of the Federal Reserve, because you have too many, the amount of variables right now. Since I've been born, man, I've never seen or experienced so much at one time, and I've never been able to make 4 cases at once either. And I can easily do that today.
Yeah, it's interesting. And I do think a big part of the real estate equation was this huge backlog of development. So I was just talking to a friend of mine last week who's a really close buddy of mine, but he's a developer in New York, or he's the manager.
Commercial?
Yeah. So they do 60 big developments every year or so. Some of them are family. Some of them are, big, commercial real estate. And so they do a little bit of everything. But he was saying because I was talking to him about this company called KB Homes. They're one of the largest single family residential.
Did you say his company?
It's called KB Homes.
No, did you say that KB Homes is his company?
No.
Oh, okay. I was about to say, damn, man. Okay.
No,
I know KB Homes.
Yeah, I was talking to him about KB Homes because I've had this short thesis for since basically summer, but essentially a lot of their valuation is based on this huge, if you look at their numbers in their their income statement, you can see this huge surge in their margin. like I don't have the numbers right off the top of my head, but I do have a whole report on it where I went into a lot of the numbers. But they had this increase in their margin, increase in their revenue growth rate, but a lot of it was based on this huge backlog of development. So like people that had started to basically decided that they wanted to buy a house and build a house during COVID, they had to wait to actually get that project done because of all the shit that was happening during COVID. And so this huge backlog allowed for their numbers to continuously look like, you know, they were improving, that the margins were improving, but it was this very short-lived thing where even in the last few quarters, the numbers have now normalized to where they were basically pre-COVID. But a lot of investors just don't read between the lines with those types of data points. And so it takes they have to actually see it happen in the quarterly financials before they can anticipate it ahead of time. And so that's why the valuation for KB Homes has come down and a lot of these other companies, because they have this huge backlog. And then there's a lot of people that are canceling some of their stuff that they had, the orders that they had already placed. There's a lot of canceled orders. And so it's just, I think that's what's propped up a lot of these single family residential home developers. And then that kind of trickles out to the rest of the market as well, right?
Yeah, no, I think we saw the last of that, like you said, in September. Actually, new home sales increased like 14% out of nowhere, and permits did as well. And I think that was like the last big spike that we're going to see. So yeah, that's interesting. I didn't think of. I think the backlog, it was more new home sales. Existing were drawing up like crazy. Even still at this point, I know with multifamily, we're looking at an overbuild scenario over the next couple of years here. We're talking about, we're already seeing, for the most part, deflation in multifamily rents. And so, yeah, I've always wondered how that, if we see a decline in multifamily rents, how that would affect the housing market. Because if I'm thinking about it in the right way, if I'm just going off of like general economic behavior, if rents for multifamily are lower than single family, well, most renters that currently rent single family, they're going to start looking towards those multifamily living spaces, which would put downward pressure on rent prices in terms of single family, and upward pressure on multifamily rents, while putting upward pressure on single family home prices as well. And so it's like, all in all, with an overbuilding scenario in multifamily, we would still have unaffordability crisis in terms of single family housing. So I don't know, man. It's like it's hard for me to see something like that crashing right now. I just don't see it unless we see a huge influx of demand. Even multifamily, even though we're overbuilding, it's hard for me to see a multifamily crash specifically, just because we're talking about living spaces in its apartments, and you're seeing more amenitized apartments. And so people stick to those places, even though they may raise rents a bit. And so I don't know. It's tough to see how the Fed comes out of this in a way that they want to. It really is.
Partially at these levels, so the thing is, at these levels where we are in terms of rates, like, you're just now starting to see some of those impacts play out in real time, because there's this huge delay in actuality of, like, you know, the real financing situation that households are under. You know, there's like that lagging 6-month, 12-month period.
Yeah.
And so I think we're just now starting to see some of those impacts actually in real time. And then I think, you know, whenever you start to see more turnover in terms of on the back end, the owners of these single family, multifamily, like when those owners start turning over more often, now all of a sudden that's when you start seeing a change in the rent situation. And so, you know, I think, yeah, there's a lot there right now that's hard to predict, but I think there's only so far that we can sustain where we are, whether we're talking about renting. I think more so on the equation of owning rather than renting. You know, just the actual equity value of these homes needs to drop significantly, in my opinion, across some of these more inflated markets, you know?
Yeah. No, I agree.
Even the people that like had this affordability going in, like after COVID, you know, now all of a sudden 24 months later, they can't afford to buy nearly what they could pre-COVID. And so a lot of those people, you know, are either priced out of stuff that they could have bought before, or they're just deciding not to buy at all, because that financing situation has changed so quickly in such a short period, you know?
Yeah, no, it has been. And then you saw the big refinance boom. I mean, you had probably, if I had to give a rough estimate, I don't have this number in front of me, but a good 65% of homeowners who bought homes under 4% engaged in a refinance at some point. During that boom, it was going pretty insane. And so even though prices have went up in some markets, you still got other markets like, the boom towns like Phoenix, Vegas, places like that. We've actually saw a decline in prices. But Detroit, Chicago, and New York led the way in terms of home price gains. And so markets like those, I mean, those people are kind of like fucked, which is why we saw like an uptick in, so I wholesale real estate, and you saw an uptick in people getting deals in places like Vegas, Arizona. And I'm in Vegas right now, actually, not physically, but working out of there. So I'm seeing it, like kind of a lot of people selling their home right now, but just not to brokers, especially with you have the broker situation going on right now with commissions, fees, all that good stuff. So that's kind of fucking them up a little bit. But yeah, for the most part, man, it's like those people who refinance, which it was kind of a lot. They're in a bad position right now. People in the Midwest who engage in a refinance, they're probably sitting pretty still for the most part, depending on where they are and depending on a bunch of other variables. So it is bifurcated in that sense, which is another reason why it's hard for me to see a national decline, just because we have very few boom towns. And we know that we knew when it was happening that the boom towns were going to see the biggest declines. We all knew that. And it's happening right now. And obviously there's way less boom towns than you got, a working man city like Detroit, So yeah, it's hard for me to see any decline nationally on that. So yeah, that's I don't want to get stuck on housing the whole time, but yeah, those are my thoughts on it.
Well, since we're coming up on an hour here, do we want to just quickly talk about like what strategies we're employing to like kind of take advantage of what we're doing in the market? I know you said you have to run. Do you want to like maybe quickly talk about the strategy you're doing right now?
I'm betting that Fed can't move much more from here, and so that the way that plays out is me betting being long bonds, long duration bonds, and then to hedge that out, I'm short the Hong Kong dollar peg, which I've been short for over 18 months now, and so that those have been good tandem trades to make. Outside of that, we have a short against lithium, the spot price, but then some lithium miners, huge surge in the total net amount of lithium based on this new lithium mine that came out. And then I got a bunch of other plays, but I'm gonna just keep it to those ones right now.
Man, you're shorting lithium. That's interesting. I wish we had more time. I would have asked you about that more.
Yeah,
shorting lithium.
Remember that whole lithium reserve when they found that big pile? He's the one who told me about that.
Oh, okay. Yeah, I forgot about that. Okay. Yeah, I would still like to dig into that, man, another time. But yeah, I'm not doing anything much differently. Just keeping cash, and gearing up to buy more real estate because real estate's gonna do well.
Inevitably.
So yeah.
Isaac, what you doing, man? And also, Isaac, I remember on like 2 calls ago, you were talking about like if you were yield farming right now, you would be like delta neutral. And I know you used to do a lot of that back in the day. Did you want to maybe break down a little bit of what that is, just so that people kind of like can get a grasp and maybe talk about what you're doing as well? I know you're probably still holding your bonds too.
Well, specifically, in our company, we built a delta neutral tool used for buying GMX, which I think is gone now. I haven't kept up on GMX in a year. That's why I always got freaked out when people were like, oh yeah, we'll have like a vault program. You'll just lock it in for a year and then we'll pay you out. I'm like, I'm locking that shit in for a year. I'm never seeing that money again. Like I will never see that money again. And those yields better be sky high. But but anywho, we built a delta neutral protocol. At least the original idea was a delta neutral protocol for people that were interested in buying GMX. I think we actually built for the GLP token that they have. And the idea behind delta neutral is that you are basically building a position that no matter where the market moves, you're able to pull out of your position with the same amount that you entered with. How we did that with the GLP specifically was the GLP was an index token. It was the value of it was based on a weighted index of multiple other tokens. I think it was like half Bitcoin, quarter ETH, and the rest was just a conglomeration of like 2 or 3 other minor tokens. There's some USDC in there, or Tether in there.
Half stable coins, and then the rest was half.
Yeah. Oh yeah. Sorry, it's half. You're right. It was half like stablecoins, and then half a bunch of other schlock. I think mostly BTC was then in that other half, then a bit of Ethereum, and and essentially those were all weighted, meaning that they would change based off of who was exchanging what for what. So like if I was gonna buy a bunch of Bitcoin with USDC, it would change the underlying pool a little bit. You'd get a little bit more USDC, a little bit less BTC, but then that would change the rates that you were paid out, which would encourage more people to give more BTC and bring it back to the weighted index that it wanted. Okay, so there was this weighted amount that it was all kind of oriented around, and we made our position delta neutral by essentially, so we would just buy the underlying tokens, and then we would of the same distribution that the index token was. So half USDC, half or like a quarter Bitcoin, a little bit of Ethereum. We would then buy GLP token, which was the index token, using that same proportion, so that the amount that we were in was proportional to the like the weighted averages for each underlying token. So that if we then pulled out, we would then have to pull it out proportional as well to the underlying weighted index, and we would get essentially the same amount out as we had in. So if USDC goes up, or like, relative to BTC, we're still matching that weighted average, so it shouldn't really matter.
Yeah, and just to summarize on the cool part about like doing a delta neutral position like that. So once you buy GLP, they made it so that you don't, they skip the liquidity providing process. So normally you have to take a pair of assets, or even if it's single side, and deposit into a pool, and you get like a receipt token, which is usually like an LP token. That's what GLP is. So instead of having to deposit liquidity, you just buy the GLP token, and the funds you used to buy it with is used to provide liquidity. So as soon as you buy the token, you're providing liquidity, and you're actually getting paid from providing that liquidity. And how you get paid is whenever traders lose, because GMX is a leverage trading platform essentially, and people borrow money to trade. Traders normally lose, so you're essentially lending them money to leverage with, or to use as leverage, and when they lose, that's how you're getting paid the yield. So the cool thing about being delta neutral is that you're pretty much longing something and shorting something, so that when one goes up, or when one goes down, the other one goes up, and vice versa. So your principal is staying the same, but you're making passive income. So whenever you do withdraw, you get to take out your fees as well. So it allows you to be like market neutral, but still generate passive income, which is pretty dope. So
Pretty dope.
yeah, and he's saying he would be doing that now because the markets have been kind of choppy, even though we've been having like a little bit of bullish momentum here. The best time to provide liquidity is when markets are really, really choppy, because they trade within a range. But yeah. And then Isaac, what bonds are you holding right now, man? Are you holding the same ones that Chris was talking about? I don't know if we ever dove into like what you were actually holding.
I'm not holding any bonds. I'm just holding a ETF right now that is paying me. It's like an interest ETF. It just pays me the basic like standard interest. It's a very safe ETF. It's a delta neutral ETF actually. So it's one where the value of the ETF is fixed at $1 per share. So I'm a very cautious trader. I don't know if people get that. I mostly do just neutral ETF. Even when the market's doing good, I usually only dedicate a portion of my funds into something that actually has like like high alpha
or directional exposure period. Yeah.
Directional exposure. Honestly, it just depends on what your risk tolerance is. I've always had a fairly low risk tolerance when it comes to my investments. But that's why these times are amazing. Crypto is some of the best actually when it comes to low or high or low risk tolerance if you want to yield farm, because crypto does have some of the best yields that you'll get almost anywhere. You just got to make sure to set up like good delta neutral positions if you really do not have a good tolerance for risk. The biggest worry though with doing delta neutral yield farming, and the only real worry, is getting rugged or not reading the fine print. Because like, you know, when we say things like GLP, we say things like, oh, there's this delta neutral position, there's a yield farm. These are all just schemes. And I know scheme is a negative term, but that's what these are, is schemes that protocols set up in order to get liquidity in order to fund them. Like they want liquidity because the more liquidity they get, it's cheaper for them to, you know, set up dexes. It's easier for them to do these leveraged positions. And yeah, like, you know, they want liquidity. So they set up a lot of these schemes to do that. And something I run into all the time when looking at new yield farm opportunities is you'll see these huge rates, massive rates, but you'll read like the white paper and you'll be like, oh, so how am I achieving these rates? And it's just a bunch of gobbledygook. It's like, I don't fully understand this. GLP was not that way. GLP was actually sick and they're an honest team, but a lot of groups are not like that. And, you know, you just got to make sure that there's no time, like, you know, there's no like time frame where you get locked in when you set up a position. They don't tax you for pulling your money out of a position, which they will. And they'll put that in the fine print and you'll overlook it because the yields are really sick and you'll jump into it too quickly.
Yeah, that's good stuff. Yeah, you definitely want to be aware of the platforms that you're doing this kind of stuff on. The blue chips are Uniswap, Aave. I'll take Aave over Compound, but to be honest, I will take Radiant over Aave just because you get paid to sit in a short position. But Aave is definitely more battle tested and it has a higher TVL. Also, Radiant just launched on ETH mainnet. They were on Arbitrum. Now they're on ETH mainnet, which is pretty cool. So definitely check out the yields there. But as far as my strategy, not much has changed. JT, I'm not entering into that Bitcoin short. Shit is too risky.
Whoa, what? JT, is that what you're doing?
No. We were last week when you hopped off. He was like, Vince, if you enter that Bitcoin short, let me know because you know,
That's
I hate to see it go
terrible.
up. Yeah.
Oh
no.
my God. I would avoid personally. This is
I'm not showing anything right now.
Yeah, I would avoid almost all directional decisions unless it's like, unless you got like major fundamentals. Like, I don't know.
I agree.
Yeah.
Or unless, you know, you don't care about duration, like you're just buying and holding. But yeah, I would agree with that 100%, man. 100%. Yeah, it's dangerous. I'm more interested to see, you know, some of these projects. It's almost like I'm actually hoping they get US exposure over the next few years. And I'm talking about these projects that are working with bonds on the blockchain. Just because, you know, all right, so on a bond yield, let's say let's use the 10-year note, for example. Today it was at like 4.6 and went back down to 4.6. If that same bond was on like a Pendle Finance and it stripped them or, you know, split them up, and I have to dig into this more, but like somehow, maybe Vince, I don't know if you can explain this, but somehow, basically, you know how they strip the bond and you have the principal token and yield token. And so on that yield token, let's say on that same 10-year bond or 10-year note that has a yield of 4.6%, somehow the yield token within a platform like Pendle Finance, you could potentially earn a higher yield than what's on the real yield for the 10-year.
Yeah, because in traditional bond stripping, you can only speculate on the current yield. But the cool revolutionary thing about Pendle Finance is that they allow you to speculate on the future yield. Yeah. And that's something that they're doing that's really, really different. And yeah, guys, be on the lookout for the JT and me. We're going to do like a deep dive on Pendle Finance, how it works. And we're going to do like a yield farming strategy on how you can accumulate it passively. Yeah. And it's like well, I'm not going to do the deep dive now. I was just about to go through all the shit. But yeah, it's and you know, I really like that protocol because it's not dependent on bull or bear market, like the use of the actual platform. Like Aave, you don't have people using it as much in the bear market. Uniswap, you don't have people using it as much in the bear market, but bond stripping is happening like no matter what, because it's essentially, it's almost like a derivative strategy that allows you to hedge. Like you have credit default swaps and all these different things, and it's always a market for options. So yeah, really excited about that protocol.
Yeah. And other than that, like I said, man, just keep buying real estate. I'm always a proponent, depending on what your strategy is, always a proponent, buying pretty much. There's an opportunity to buy at any time in any market environment. There's always a strategy that you could use. So it literally depends on your situation, who you are, what you know, and a lot of things. But yeah, real estate will always be in the play every time that question comes up in the future, just so you guys know.
Hell yeah. Well, I will go ahead and take us out here. So our course is going to be going on sale this week. If you guys want to learn from all of us, go ahead on the website. You'll be able to book a call with me. We'll go over like your goals, your strategy, your time preference, your experience, what to expect from the Know It All Academy, what to expect from the coaches, et cetera, et cetera. And obviously we're looking for people who are serious about their financial future. So that sounds like you. We'd love to meet you in the future. Other than that, we'll see you guys on the next call.